Hello, everyone. This is Jay Jordan. Welcome to the second quarter 2023 Heritage Wealth Advisors webinar. I'm joined today by my colleagues, Gary Baronian and Steve Henderson. And our hope today is that we can provide you with some highlights of recent market activity, as well as provide you with our outlook as it relates to both the macro economy and financial markets, and then ultimately talk about the positioning of client portfolios. So maybe to set the stage, we're now a year into arguably the most aggressive monetary policy tightening in financial market history, certainly in Fed history. And we all know that it takes time for interest rate increases and tightening financial conditions to work their way through the economy, both from an economy's perspective, from a business perspective, and from an investor's perspective. But wow, we really seem to be seeing the stresses in the economy begin to present themselves with the second largest bank failure in history, with Silicon Valley Bank failing back in late March. And yet when we look at the markets, they seem to reflect a different picture. So Carrie, maybe you can help us understand and relate that some of the activity and highlights we saw in the quarter with where we are from a market performance perspective.
Sure. So we saw the S&P rally to start the year. To an extent, we think that's normal given how much it was down last year. So a rebound driven by rebalancing after aggressive tax loss selling at year end. I think it's important to point out, though, that there were 6 mega cap technology stocks that contributed more than the entirety of the S&P's 7.5% gain for the quarter. They were Facebook, Apple, Google, Microsoft, NVIDIA, and Tesla. Collectively, the other 494 stocks in the index were down for the quarter. So unless investors were holding a highly concentrated technology portfolio, they most likely didn't keep pace with the market. Would say, generally speaking, our equity allocation in client portfolios generated slightly positive returns for the quarter. And we feel good about that, especially coming off a year where we meaningfully protected capital for clients in a market that was down more than 18%. Turning to fixed income, the Barclays Ag Index was up about 3%, driven by falling bond yields. Looking forward, when we think about the potential path for the broad equity and fixed income indices, we are skeptical that these rallies will continue. And I think we'll get into our reasoning for that later on in this conversation. And then maybe a quick word on gold. Gold was up 10% for the quarter, we think partly driven by the bank failures and concern about instability within the overall banking sector. Steve, how would you recap what went on in the private markets?
Yeah, so keep in mind, when the private markets, we're still talking about 2022. It's close, but valuations are still trickling in for the fourth quarter of last year. Listen, there was good and there was bad in the private markets last year. What was good? Private credit was good. The ability to get 10 to 12% net returns was there throughout the year, and it's only the opportunity's only gotten better as a result of things like SVB blowing up, because the world needs to get financed, and the pools of capital in the private credit space are going to be that source of financing. So credit was good last year. Energy was good last year, right? I mean, it's a very capital starved industry. We need it. Yes, we're on a transition to renewables, but that's going to take quite a long time. So in the meantime, we still need traditional energy, and that sector of the market was up, call it 15% for last year. Flip side, venture capital struggled, right? You're talking about a world that's not profitable by definition. The revenue can be growing quite rapidly, but in a world where rates go up 400 or 500 basis points in a very short period of time, throw SVB on top of it puts a lot of pressure on the venture space. So broadly speaking, it looks like the venture capital market was down about 25% in 2022. So a mixed bag, lots of pressure, lots of opportunity. Jay, maybe talk about some of the things as we look forward.
Yeah, so from an outlook perspective, it's important to think about how your views may differ from the broader consensus in the market. And I think where we're challenged is that when we look at the markets today, when we look at the economy, it appears to us that there's increasing hope that the Fed is going to be able to engineer a soft landing for the economy through either a stabilization of interest rates, or ultimately, I think the market's expectation is that there will be a Fed pivot based on some weakness in the economy. And our challenge is that when we look at the underlying fundamental data, a hard landing appears increasingly likely. And maybe to hit on a couple points, if you look at underlying economic data today, industrial production is weakening, retail sales are weakening, housing has been very weak, as it is the initial, it feels the initial impact of rising interest rates. And at the same time, thinking back to the comments earlier about the failure of Silicon Valley Bank, while and stresses in the banking sector broadly, while we don't believe that we are in an environment where we have a risk of a systemic risk, solvency risk within the banking sector, we do believe that the stresses within the bank system, as deposits are flowing out of banks and moving into money market funds and moving into treasury bills, does suggest that we are likely to see tightening, and we are already seeing tightening financial conditions on the parts of banks. That suggests to us that the likelihood of a recession is in fact rising, not falling in the current environment. And part of the reason for that is that when we look at inflation, inflation remains persistently high. The most recent CPI print was down to about 4.9%, which is certainly well below where we were 12 months ago, but still is reflective of a much higher inflationary environment than the Fed is ultimately targeting, which is closer to 2%. At the same time, when we look at underlying core inflation, which strips out food and energy prices, which tend to be pretty volatile month to month, we actually saw inflation increase in the month of March. And so I think the challenge that the Fed faces is that in order to bring inflation down, the Fed is going to have to ultimately impact demand and increase unemployment in order to move through some of the structural forces that we would argue suggest that inflation could be higher for longer. So what does that mean for interest rates? The challenge is that interest rates have risen and the economy is working through and acclimating to a higher interest rate environment where the cost of capital is rising, but real yields are still negative, particularly at the longer end of the curve. And that suggests that the Fed has less flexibility to ultimately lower rates until we see inflation come down meaningfully. And at the same time, when we look at spreads within the corporate markets, while spreads haven't moved dramatically within investment grade corporates, in the lowest credit quality sector of the market, those companies that need credit the most, we've actually seen spreads widen pretty meaningfully, and that's going to have an impact on the economy as well. And so, broadly speaking, our view as we look at the overall economy is that we're going to be in a more challenging environment where, in our minds, the likelihood of recession is actually increasing, not decreasing.
Yeah, and so to add on to that, it's so interesting, while forecasts for economic activity are falling, forecasts for corporate earnings are rising. And that's nonsensical to us. Expectations for earnings are basically for them to plateau at all-time highs this year and grow by 5% next year. We're skeptical that these numbers are achievable. Just thinking about the backdrop you laid out, Jay, slowing economic activity and elevated inflation and interest rates should represent headwinds to both top-line revenues and profit margins. And then from a valuation perspective, the S&P is trading at about 18 times forward earnings, which is above historical average and suggests that the index is expensive. And that's based on the earnings estimates that we believe are potentially unrealistic. Using our estimate of normalized earnings, the S&P has an implied valuation multiple closer to 21 times. So if earnings disappoint or interest rates move higher, causing valuation multiples to compress, seems likely that asset prices across the board will need to reset lower. Would not be good for future returns. So I would say for these reasons, we continue to proceed with caution when it comes to managing client portfolios.
Yeah, and I think to take, that backdrop that Gary just presented and think about our positioning of portfolios, as Gary mentioned, our overall positioning really hasn't changed over the course of the last 3 months, or really over the course of the last 6 months. Is we do believe that in given this backdrop, that continuing to be focused on risk management and preservation of capital is appropriate. We have, however, taken some specific steps that I think are instructive as to how we do have portfolios positioned. One of the things that we have done over the course of the last 6 months is we have taken down our exposure to the financial sector broadly, both in terms of removing our investments in preferred securities, which are heavily dominated by financial company issuers, as well as taking our bank exposure down pretty materially over the course of the last 6 months. All of those are reflective in our minds of a more challenging economy, as well as stresses within the financial sector specifically. We've also taken down our exposure to corporate bonds. Again, in an environment where spreads don't appear particularly attractive, and yet we believe that there are likely to be some stresses within the broader economy in a more recessionary environment. We don't believe that we're being paid value to own investment grade corporate bonds and then finally, where we have been finding value is in an area, again, coming back to there is no alternative. There's been no alternative to equities and to 0% deposit rates until now. We do believe that there are alternatives that are attractively priced. And specifically, when you look at shorter term treasury bills, and when I say shorter term, I mean 1 to 2 year treasury bills and shorter term treasury inflation protected securities. Again, where in our view, we believe that we're being paid an attractive interest rate, an attractive return to take a very modest amount of risk, to take very little interest rate risk. And in the case of treasury inflation protected securities, we actually have the ability to build what was ultimately an insurance policy into the portfolio, in the sense that if our view is correct, that inflation remains higher for longer, then this is an investment that will ultimately pay us a very attractive rate of return. But see, maybe take that that same thought around positioning and think about the risk and opportunities within the private market.
Yeah. So look, we're cautious in the private markets as well. I mean, I think it's going to be an extension of what happened in 2022. There's some things we like. There's some things we like long term that we're going to hold off on for now. So what do we like? We like private credit still. It's a lender's market. You can get higher yields. You can get better covenants. You can get lower loan to value. You don't have, on-demand deposits that you have to deal with like a traditional bank does. So you have a captive pool of capital. You can go in, you can dictate terms. Businesses need the money. We like the private credit space. We like pockets of the private real estate space, specifically multifamily, industrial and warehouse, hospitality. We like those sectors. We continue to shop through e-commerce channels. Those businesses need to store their inventory somewhere. Industrial. That the country's undersupplied from a housing perspective. We like multifamily. The world's starting to travel again. We like a very specific sector in the hospitality industry. So we like all those. And what do we not like? We don't like the office space. Something like $30 billion of commercial office buildings have to get refinanced in the next 2 years. That's a pain point. It's coming. And we don't like the traditional retail space, bricks and mortar space. There's some pockets could be okay, but just broadly speaking, we don't like it. We do like the energy space still. We need it. We're going to keep needing it. And it's a capital starved corner of the market. And if you're willing to provide capital to it, there's tremendous opportunity. We've always liked, and we still like, and expect to continue to like the buyout space, lower middle market buyout strategies. Can you purchase a business at a good price? If you say the EBITDA is 10 million to 100 million, give it a little range. And then can you grow that profitability of that business and then exit it? It's a time tested strategy that works well, over time, consistently. We like it. And then that brings us to VC, venture capital. Serious pressure. You're talking about unprofitable businesses that might be growing their revenues like rapidly, but the market's really punishing that. here today. It's what is that worth if you go from 100 million to $200 million in revenue and you're still not profitable? In today's world of 5% interest rates and uncomfortable inflation, that's really getting punished in the market. But it's an important ecosystem for all of us. It's a tremendous source of business creation. Kerry mentioned the 6 stocks in the S&P that did well in the first quarter. Those were all venture-backed companies. So something like 50% of all publicly traded stocks in the US were venture-backed companies. They represent 72% of the market cap, over 90% of the capital spend on research and development. It's important, and we believe in it long term. Entrepreneurs are still going to innovate, and we are talking to lots of VCs right now, but we're going to be a little cautious because these things that Jay and Kerry mentioned, this story's not over yet on the inflation and the FOMC, and can create more discomfort. And the real thing to pay attention to is if you're a venture-backed company, you're not profitable. That means you're burning cash on a regular basis. There will be a moment in time between today and 2 years from now when you need to raise capital. And if it's sooner rather than later, it's almost certainly going to be at a lower valuation. So you can't time this market at all, really, but you can time when you start investing. And so we're going to be patient as we consider it throughout the balance of 2023. So some really interesting things here, short term, near term to invest in, some things to kind of pay attention to, but be a little more patient. Overall, cautious.
So Kerry, the question we constantly ask ourselves is, where could we be wrong?
Yeah.
So where could we be wrong, and help us understand if we're wrong, how we could be wrong and how that could impact portfolios.
Yeah, I think 2 scenarios come to mind on that topic. First is the Fed cuts rates and investors rotate into fixed income as a safe haven asset. In that situation, our fixed income allocation, which is short duration, would not provide as strong of a counterbalance to our equity exposure. However, would also say potential offsetting factors include the facts that we are taking very little credit risk within our fixed income, and we continue to manage our equity exposure below long-term targets. So said differently, shouldn't need as much duration or counterbalance. And then the other scenario that comes to mind is if inflation rolls over. We do have several inflation hedges within the portfolio, the natural resource equities, TIPS, and gold. On the natural resource equities, would say, while we believe those businesses would be negatively impacted by a cyclical slowdown, we also believe they should benefit from structural trends longer term, including the ongoing industrialization and urbanization of emerging markets and the continued shift to energy efficient vehicles. On the TIPS, to kind of piggyback on what Jay said earlier, TIPS are offering an attractive positive real yield, and they are priced for inflation to return to long-term average. So unless inflation drops below 2% and stays there, we believe that we should benefit from the optionality associated with those securities. And then on gold, we do believe that gold is tied to other forces besides inflation. For example, we're seeing structurally rising demand from foreign central banks, and that's really accelerated since the confiscation of Russia's foreign currency reserves last year. So yeah.
And so I think, maybe to summarize, if I had to pick 2 words to summarize where we sit today, it's caution and it's patience. Our view is, the economy is an aircraft carrier, and so it takes a long time for the impact of rising interest rates to make their way through the economy and ultimately pivot the economy towards a weaker trajectory. And we're in the very early stages of that. As I mentioned earlier, housing is kind of the tip of the spear, and we've already seen housing weaken dramatically as interest rates have gone up. But in an environment where we continue to believe that the economy is likely to weaken, and expectations within the market suggest a very different view than what we see on the economic side from a fundamental perspective, our view is that it is appropriate to continue to focus on risk management, continue to focus on preservation of capital, and be patient as we work through time, we will get the opportunity to deploy some of our clients' dry powder into more attractive return opportunities, but we don't believe that we have reached that point today. And so we'll continue to manage client portfolios with an eye towards preserving capital, and looking for opportunities that ultimately present themselves both in the public and private markets. So I'd like to thank both of you for joining me today, and thank all of you for listening in. Certainly, if you have additional questions, please don't hesitate to reach out to your advisor or to any member of the team. We look forward to speaking to all of you ultimately about your individual client portfolios and your individual circumstances. So thank you very much.